welcome everyone to Hampshire Capital, our Hampshire Capital Diversified Real Estate Fund 1. Happy to present the opportunities we have in here in front of you, and we're going to go ahead and get started. If any point you have a question, please put that in the chat. And then if you at any point want to go ahead and view an investing portal, Brendan will put that investment portal up in the chat as well. And look, our promise to you is to stick around because we're going to have Q&A at the tail end of this, and we have common investing fears coming through about the middle of this presentation. So please stick around, stay to the end. There's going to be tons of time for you to ask your questions. So please do so. Go ahead and get started. I want to go ahead and introduce us to the team. Shane Carter, if you kick us off.
Yeah, thanks, Eddie. I'm principal and CEO here at Hampshire, and for the last 25 plus years, I have been involved in construction, development, and real estate, mostly in single-family residential development, as well as multifamily asset ownership. And I'm proud to be the guy who gets to lead the culture of these amazing individuals that you're about to meet. So over to you, Nick.
Thanks, Shane. Appreciate it. Good afternoon, everybody. My name is Nick Bouquet. I'm Shane's business partner, a co-principal here at Hampshire Capital. I am in the COO role, and I've been involved in commercial real estate, in particular multifamily, for about 15 years. I've transacted on a bit over 5,000 units, about $500 million in total transactional value. And I'm focused on managing the day-to-day operations of the company and also on driving the investment and underwriting and analysis side of what we do here.
Thanks, Nick. You do that extremely well. Eddie Alston here. I'll be your MC, also Vice President Operations and Construction. I've been in real estate a little over 20 years. I'm diversified from business to commercial investments, construction projects nationwide, housing subdivisions, multifamily. Anything that you have questions on in real estate, I am always your advocate for education. Happy to advise. I love giving to others, and that is my passion, is to help other people out, and I'm in the help business. So please, if you have any questions, bring them our way. We're happy to answer them. Brendan, go ahead, buddy.
Appreciate it, Eddie. How are you guys? My name is Brendan Manning. I come from the family office space for many years, on strategies all throughout the capital stack. My role here is investor relations, all things investor relations and capital formation. I'm happy to answer any questions that you guys might have related to the fund or any other opportunities we have. And, I think everybody deserves 30 minutes of time, and I'm happy to sit down with you and really figure out a way that we can make your investments worth your while. And it's a pleasure. And I have my email here in the webinar chat. And if you guys want, throughout the entire course of the webinar, if you guys have any questions, you can just pop it into that Q&A, and I'll be sure to answer you throughout the whole thing.
Thanks, Brendan. Go ahead, Mo.
Thanks, Eddie, and good afternoon to all the guests joining us. My name is Mo LaPointe, VP of Land Acquisitions. Been involved in multiple commercial real estate transactions over the last several years. Currently focused primarily on delivering value creation through our land development positions, multiple positions, that is, right? And really just excited to have everyone here on the call learn more about our projects. So again, thanks for joining us.
Thanks, Mo. Michael, round it out.
Sure. Thank you all for being here again. My name is Michael Payne. I'm the Vice President of Asset Management. I've been in the real estate business for about 2 decades. My main focus has been on multifamily, with doing some side deals on land as well myself. I've had a portfolio of the size of around 7,000 units and over $1 billion in value since 2007. I've also been, president of the Fort Worth Apartment Association, as well as a board of director of the Texas Apartment Association. So I pride myself in making sure I know people around all of the different areas of Texas and anywhere else I can get into, so that I can make sure that we maximize what our returns are, any investments we have on the multifamily side, as well as anything from a land standpoint. So welcome you here today, and thank you for your time.
Thanks, Michael. All right. One of the things that I love about us is our unique position at Hampshire Capital and the things that we offer. And in this first slide, I want to go over our investor first philosophy. First, I want to explain what that means. We all here at Hampshire Capital are investors. We understand real estate. We understand returns. We understand how to reserve our capital and get capital preservation and risk adjustment We look at all the different ways as we are investing ourselves because we are investing. So we have an investor first philosophy, a complete alignment and transparency around our capital preservation. Next is our neighborhood first mission. Michael and I sometimes go out and we visit our properties, and this is one of the things I pride myself on is our neighborhood first mission. We want to make sure that our properties are clean, safe, our residents want to live there, and the community is proud that we've bought these properties, we've renovated these properties, or we've built them new. So we pride ourselves when we go to our properties and we look at everything that we do to make us stand out and different. And it's kind of our cornerstone for long-term growth. The people that invested with us that see our buildings after we've renovated them, our tenants come up to us when we're there. They are very pleased to live there. They feel safe. That really makes me happy to be able to visit our communities and see what we've done in the neighborhoods. Next is we're a team of experts. We're dedicated, full cycle, experience in commercial real estate and in alternative investments, whether that be through land or multifamily renovations, all the different things that we do. Investor service and education is what we pride ourselves on. Next thing anyone should ask is a track record. What's our track record look like? The principals and partners of this Hampshire Capital have over 70 years collective experience acquiring and renovating, operating multifamily apartment buildings, construction, and commercial properties and land development. To date, we've transacted around $550 million and 5,600 units. And our raw land development and development opportunities, we've done about $125 million and 320 units. Common investing fears. I just made a reel on this earlier today about common investing fears. I get these questions all the time, so we went ahead and put them in this slide so we can go through them. Investor questions. This is what we hear all the time. I'm going to have Brendan chime in on here in the last one on what you should ask your fund manager. I'm going to take the first two. So the first one I get is now the right time to be investing in real estate. I'm going to be completely frank and honest with you. I think the best time to invest in real estate was yesterday. The next best day is today. Anytime you can find a piece of property that you can underwrite and you can make good returns on, it's worth buying, it's worth investing in, it's worth renovating or developing it. It's always a good time. The only people that lose are the ones that don't take the shot. The next thing is, why should I invest in a fund versus individual properties? I absolutely love this question. And here's why. I'm a fund manager, came from fund management straight out of the gate. I have syndicated multiple properties, but I love funds, and here's why. If we're going to go out here and buy ourselves around 5,000 doors, we're going to split that over 14 different syndications. That would mean we're going to have to syndicate 14 different times. And every one of those opportunities, everything relies on one address, one property, one underwrite. Everything has to go right. How many people believe that you can do it 100% right 14 different times? Maybe you're lucky. I wouldn't put all your eggs in one basket. You put them all in one basket, you drop it, you could break some eggs. You lose some money. So I highly recommend, if you have more questions on fund management, funds, please bring them our way. With a fund, you diversify. If we were going to do 5,000 units and 14 different properties, we'd probably do about 3 or 4 funds. We'd put 3 or 4 properties, maybe 5 in each fund. That way it's a blended return, blended risk across all the different properties. Brendan, what are some questions that you get all the time when you're talking with investors?
Sure. Yeah, Eddie. I think there's a bunch of different questions. One of them, is definitely why should I invest in a fund, just like you said. And I think the reason so many people love multifamily in general is because of the economies of scale relative to single family. And, I think the fund setup is definitely, an attribute to that, and it allows you to do that even more. And then also I would say, what's your track record is probably the number one question I get. And, have you been able to do this successfully, right? And, a track record of successful execution is a huge thing and almost vital to ask, because these webinars, are great, and, the marketing of these things is phenomenal, but can you showcase that you've done this before is really what it comes down to. And, I think our principals over the last 3 decades have done phenomenal in certain sectors. And, I think we're really proud to say that. And it's definitely something that, I hear quite often, that we're proud to answer, saying we absolutely do have a great track record. Yes.
Thank you. It's kind of funny. I had a call earlier today, and during that call, the person asked me, how's 2024 treating you? I know a lot of people that own and operate multifamily aren't really weathering the storm very well. How are you doing? I said, well, I'm going to be completely honest. Most of us on my team have been in real estate a little over 20 years. We've done this a long time. We've learned from our lessons. And I'm proud to say that we have no properties in foreclosure, that we are a person or in a company that we don't over leverage. Oftentimes the market tells you to put down 20% down, 25% down. I haven't seen a deal that we haven't put down 35, 40%. We don't over leverage. Our executive summary here, this is going to kind of get in the nuts and bolts of the fund. Over here on the right side, this is the size of our fund. Our target is $50 million. Our preferred return is 10%. And our average annualized return is 20 to 28%. Our average hold period, we can hold up to 7 years, usually 3 years, but 3 to 5 is kind of the sweet spot. So we can hold up to 7 years, but 3 to 5 hold periods. One thing I want to emphasize on is no fund level fees. I want to repeat that again. We have no fund level fees. As an education point, if you're looking at different PPMs and you're looking at different opportunities, pay attention to the fees. A lot of times people charge a lot of fees inside a fund, and the fund manager makes a lot of fees. The lower end of the scale is kind of the 2 and 20 model, meaning if the fund makes 20%, the fund manager makes 2%. Gives an incentive for the fund manager to perform. We took all of that out. This particular fund, we have no fees. So we are leveraged to make sure that we actually perform on this, giving all that money back to you. Our alignment of interest is with our investors. How we decided to allocate the different funds to our different properties is multifamily is a stable investment. Apartment communities provide stable and balanced return from cash flow and appreciation. We also do outdoor hospitality. It's a cash flow model. It's an emerging asset class, generating higher predictable monthly cash yields. And then land, our land development arm, it's a total return. It's detailed risk mitigation process and high total returns. A little bit more on the nuts and bolts here. I want to hone in on our asset classes here, or the different classes we have. We have class A through 4. The first one here is a 5-year projection. That's a 17.2% average, or 17.2% IRR, and a 20% average annualized return. That's a 2x multiple. You can see on the investment side, over here on the right-hand side of the screen, you're incentivized by how much money you put in, and that changes the class that you fall into. Again, no fund level fees for enhanced return for larger investments. Shane, go ahead and speak on this one here, buddy.
All right. Thanks, Eddie. Appreciate it. So this slide really illustrates our diversification and how we blend risk and our fund. And so just looking at the pie chart, if you will, half of it is in multifamily, which is a balanced cash flow and appreciation play. And the other 2 sides of the bucket are really outdoor hospitality, which is a very high cash on cash return, high yield, and land development, which has a high total return, but really doesn't have any cash on cash metrics associated with it. So this is really about balancing a portfolio. And that's how we thought about this fund is, again, we're investors in the fund, and how do I like my money managed, and how do I like to place my assets? It's really about I want total return, and I want that segment of it to be balanced with a more balanced cash flow and tax benefits. And so that's how we constructed the portfolio accordingly. So you get a good balance of the cash flow as well as high total returns for a great blended return. And again, we spread risk across asset classes, geographic regions, and like Eddie said, 14 or 15 different assets are really going to mitigate and diminish the risk profile on any given investment. Again, the tax efficiency relative to depreciation, cost segregation, et cetera, is a huge benefit of the fund in terms of at least the multifamily and outdoor hospitality asset classes. And it's a real efficient use of time. So rather than having to go out and vet 14 or 15 different deals and 15 different opportunities, you as an investor and we as investors can really just vet a specific vehicle that meets our allocations for investing in a fund in this asset class, and know that it's being managed by the right people in the right manner with a lot of track record and experience in it. You don't have to vet each individual deal. You're getting a blended return and blended risk profile across all those assets.
So a little bit more here on Hampshire Capital, our investment framework. We have a disciplined approach. We do macroeconomic based approach. We're data-driven analysis. We look at the neighborhood level data. We really dig in with our underwriting. We want to understand, is the market emerging? Are we sticking in a point? Is it green growth? How does it look? Do we have net migration? Another thing is we are risk mitigation, prioritizing the preservation of capital. We want to make sure that we are doing everything possible to remove the risk of that. Active management, a hands-on approach. I don't think anybody in the room does a better job than Michael Payne with looking at every single detail. Michael, if you'd like to talk about how we actively manage our properties, I think that'd be a great time.
Sure. I mean, just giving you some examples of some of the things we do. There's everything from weekly calls with our property and asset teams that we have on site at the different properties. We're actively looking at what's going on with the numbers, actively inspecting our properties by going out to visit periodically and making sure that things are working on the ground and that they tie to the financials of what's going on with these properties. It's easy for properties financially to look like they're doing great, and then the delay can kick in if you're not actively going out and seeing what's happening. So we blend all of these different things of, if it's meetings, if it's reports, if it's analysis. Nick and Shane and the guys will all tell you, I call it my tea leaves. I've comprised a set of different items that I like to look at to say, what's the health of a property? And then basically creating a green, yellow, red to tell me, where do I need to investigate more on what's happening at different properties for different reasons. So it's all about blending the different things that are going on, and not just that property, but looking at what's happening in our macro market, from a higher level standpoint, and saying, okay, let's look at both what generic at 30,000 level is happening, and at 100-foot level, what's happening, and how do those all sync together? And that's how I like to compare and create the way that we're actually functioning as a business at each one of these entities. And then as a whole, how are we doing overall as well?
Absolutely. Thanks, Michael. Another thing I want to really hone in on here is, we're a relationship company. That really comes down to strong partnerships. So we look at everything we're doing as partners and relationships. We want to make sure that we have a good alignment, and we're partnering only with best-in-class operators and capital partners to make sure that everybody has our same alignment. Clear diversification, again, as Shane talked about on the previous slide, a blend of cash flow, yield, and total return. And we're totally a people-first philosophy, commitment to thrive in communities for residents. Nick, if you want to take us away on this slide.
Yeah, I'd love to. Thank you. I'm going to run through kind of what we're seeing in the market right now and really what we've been seeing and tracking over the last 12 months and kind of how we're viewing the world for 2025. So I'm going to start with multifamily since it's the largest portion of the fund. Multifamily's had a number of headwinds over the last 12 to 18 months, a variety of factors playing in there, but predominantly rising interest rates that's created challenges in the capital markets, a historical supply side delivery putting pressure on occupancies and rent growth. But also we've had a broader market downturn in terms of demand and what the tenants are willing to pay for rent and just the amount of people out there looking for housing. Some of that is, again, part of the supply side issue, but there's also a broader kind of economic challenges we're seeing in the market as well. You know, long term, multifamily absolutely has long term strong fundamentals. We believe in the asset class and its potential, but we really haven't seen a lot of buying opportunities in 2024. We think with the economic shifts and that supply side getting absorbed, we think that's going to improve probably starting in about mid 25 and into 26. We, as Eddie mentioned on the prior slide, we're very deep in the data. And so we're looking at data at the city and at the neighborhood and submarket level on a monthly basis, trying to track where the market is going. And we're really looking for certain points of inflection that we really just haven't seen yet, as far as where rents picking up again and occupancy improving. We want to make sure that when we're deploying capital into multifamily, we're in the stream at the right time when it's picking up pace. And right now, it's not that it isn't a good time to buy multifamily. It's just a very challenging time to find a multifamily deal that makes sense financially, given the headwinds that multifamily has experienced over the last 12 to 18 months. The data I'm looking at, I'm actively sharing with Michael. He's taking that and then layering that on top of what he's seeing and actually seeing day to day in the field with the investments we have. He's also giving me real time feedback that we're constantly talking about and iterating on as well. So we think we expect to be deploying capital back into multi into 25, but so far in 24, it's been a challenging year, and I think I think that's a theme you'd hear from a lot of other sponsorship groups as well. The converse of that, the land development and RV outdoor hospitality aspects of the business are very well positioned for investment this year. We've got 2 active land development deals, both of which are closing in January, February of 25. We've got a strong pipeline of land development opportunities for the balance of 25. And outdoor hospitality also has not seen the same pullback and recessionary pressures that multifamily has, and is still also well positioned for investment into 25.
Thanks, Nick. We're not going to take this slide away from anybody. This is Shane Carter's area of expertise. He's passionate about it. Let's hear it, buddy.
Thanks, Eddie. Yes, this is one of my areas of passion. You're right. It's something I've been involved with for 25 plus years. Absolutely love it. It is the tip of the spear. It is where we all live in our homes, starts right here at land development. And we focus in a really interesting part of the ecosystem in that regard, where there's amazing returns, high barriers to entry, really, really strong fundamentals and tailwinds. And because we know this industry so well, we apply to it a diminished risk profile, which is very different from, I think, how a lot of people treat land development. Real quick on each of those points, total returns, we've seen anywhere from, 30 to 40 to even 50% plus returns in these deals over time. And that sort of project level, really high barriers to entry. It's one of those things where it's sort of like you have to have money to get into development, and you have to know development to get into development. And because of our track record and experience, we're uniquely positioned to offer this asset class to investors. And that's why it's in our fund, is that simply something that most people can't get access to in terms of investment opportunities. We're really focused in, not only the entitlement process, yes, but the horizontal land development. That's really where the rubber meets the road, and that's where there's the most inefficiency in the market, and where there's the most demand in the market. And so that's where we try and serve the national home builders in the marketplace accordingly. So,
Yeah. And Shane, can you define horizontal land development for the folks who may not be familiar with that term?
yeah, sure. So horizontal land development are taking the raw land and clearing the trees, if needed, putting in the roads and infrastructure, the water, the sewer, the storm water management, the lighting, the paving, the curbs and gutters, et cetera, and creating individual lots, individual sites for builders to build the homes on. So we build the infrastructure of the developments and the communities where builders want to just build foundation to finish, which is the vertical component. So we call ours the horizontal because it's just the horizontal component. And so the favorable fundamentals are massive. Everybody knows we're in a housing shortage. It's acute. It's everywhere in the country, and it's specifically acute in the Sun Belt, where there's a huge demand. There's continued net migration patterns that drive that, and there's continued housing shortage that occurs. And so we're fortunate to be able to capitalize on those fundamentals. And this industry we're chronically undersupplied. Most economists agree that we're about 3 million units shy nationwide, and we need about 1 point, and that number continues to grow at a homeostasis level, at a balance level. We're at about 1.2 to 1.25 million units per year is what we need to do just to keep pace with the rising of household growth. So what does that mean? That means if we were able to produce 1.75 or an extra 500,000 homes per year, that would take us 6 years to get to a balanced state. And all economists agree, and all home builders agree, that we would struggle to even come close to being able to achieve 1.4 to 1.5 million. So this thing is going to go on for 12, 15 plus years until we can finally catch up with the undersupply of housing, just to give context to everybody. And then the last point, diminished risk profile, is that because we've been doing this for so long and we understand it so intimately, we have removed the greatest risk profiles in the area, which are, number one, the zoning and entitlement risk and the ability to actually have a project functionally work. We take that off the table. We don't take investors' money and then we spend our own money, we spend our own time and energy to make sure that that big risk up front is simply off the table. It's an as of right project by the time we bring in capital, and it's ready to close and it's ready to go. And so there's no entitlement risk, there's no zoning risk, there's no wetland impact risk or wildlife impact, and we sort of take all those risks off the table. Oh, I think you skipped on me there, Eddie.
Nope, sorry.
Yep. And so the other side of the risk is really who's going to buy the asset, who's going to buy the lots. And we get those forward contracts with the builders. And maybe that's why you're going to the next slide, is that's how we really mitigate risk in this asset class, is by making sure that we have the buyer in place before we take in investor money and close on the land. That's a huge risk mitigation profile, is already having a contract with the home builders to take down the lots before we ever even buy the land.
Awesome. Is everybody ready to go to the next slide? Because I'm excited to show the next slide, as you can see me jumping forward. So if everybody's ready, let's go. Let's jump in the next slide. Shane's got a few more points here as he talked about, the forward contracts. So go ahead through this, Shane, and talk about the different ways that we look at this and how we're doing this.
Yeah. So here's a deal in Kentucky, 18 lots, all single family. Again, we're just serving the horizontal land development. There's no entitlement risk. It's already fully entitled, ready to go. We're taking that off the table. So when we take an investor capital and close on this thing, it's done, it's ready, permits in hand. And so it's an off-market opportunity. This is not something that we had to go bid on. Because of our reputation in the market, we have deals brought to us because people know who we are and that we know how to do this well. And so this was brought to us as an opportunity. Again, we have a forward purchase contract with, I think I could say, and this one is D.R. Horton, that we're working with, the nation's #1 home builder. So they're going to buy all of the lots from us, and where they're giving us a contract and a deposit up front that we can use in the capital stack that furthers their skin in the game and diminishes our risk profile from our own debt and equity perspective. And so it's a great growth market, highly desirable Lexington suburb. And again, that reduced counterparty risk from the nation's #1 home builder, you can't get better Class A counterparty risk than that. So the buyer takes it down in phases. So this isn't a one-shot deal. We don't build the entire project out and incur all the expense, and then when it's done, they buy it. Instead, as we get through the first 50 lots of infrastructure, they take it down and buy 50 lots. And then we go to the next stretch, and then they take it down and buy it. So that phased acquisition, again, helps us mitigate risk because we are incurring expense and incurring risk only in time to be able to receive the income and then take that risk off the table. So it's a sort of just-in-time delivery that really keeps our risk profile low. And then again, the entitlement risk I already mentioned, we already have that fully baked.
So Shane, a couple more questions here, and kind of goes back to the common questions or the common fears. So, one of the questions we've got before is, inflation goes up. We understand that. So what happens if we carry this project over a couple years? What things do we put in place, like escalators or something like that, that we can make sure that, that price goes up with inflation or however that goes?
Yeah, great point, Eddie. We all of our contracts with the home builders, and in this particular case as well, we have escalation clauses so that after the first year, the lot prices escalate. It's usually in the 2 to 4% range that we negotiate for. Of course, we're always pushing towards 4% plus, and the builders are always pushing closer to 2%. But there's always an escalation clause that's in there that allows that lot price to increase in value as the project goes forward in time to account for those inflationary risks.
Yep. And then the other question we get is, what happens, this is a publicly traded company. What happens if, D.R. Horton decides that they don't want to build this anymore? So talk about the way that we diminish that risk as well, and how we can use deposits and the ways that we work with other people to come in underneath this.
Yeah, absolutely. So we always get, deposits from these builders, and that deposit is based on the finished lot value, not the value of the land as we have. So we're getting, anywhere from the low end 10% deposits from the builders, all the way up to 20% deposits from the builders of the finished lot values. Not of our raw land values. So that relative component of our risk can be pretty large. That money is released and fully utilized in the capital stack, meaning the risk is completely on their side. If they don't perform and they don't take the lots down, they lose that money. So in your example, Eddie, what happens if D.R. Horton says, "Hey guys, we bought 100 of these lots and there's 218 left, and we just don't like this anymore. We're out." Well, we just keep their deposit, and then the other thing that we do is we always have at least 2 other builders on call and on ready that are looking at this same exact project. Even though we're contracting with D.R. Horton moving forward, we're still showing it to all their competitors and saying, "Hey, would you guys like this project? And would you like it at this price point? And what would be your lot takedown cadence, and what would that look like for you?" So that we have their interest and their buy-in already. So if the folks we're under contract with drop out, we keep their money. We've now lowered the basis on the project, and we can then deliver those same lots to another builder for actually less, because we have our basis lowered and still complete the project in a timely manner.
Absolutely. And there's one more thing we've been talking about is when we do these larger projects, and we got a site work developer that is site work contractor that's very efficient and they can deliver lots very quickly. Sometimes these home builders may only want to take 50 lots at a time. So in that case, we've talked about internally letting other builders come in and share on this project. That way we can actually deliver these things out faster. Can you emphasize on that a little bit?
Yeah, sure. So, whenever possible, we like to keep all of our projects in the 2 to 3 year time period, especially for horizontal land development, infrastructure development projects. We just don't want, we're just not interested in having those projects go beyond that mark. So if it looks like a builder's takedown schedule is gonna not fit in that buy box or in that window of time that we've deemed as our max takedown schedule, then we'll engage with other builders to take down lots at the same time, probably in different areas or different price points, so that they're complementary, not competitive. And that allows us to sell through the project faster with 2 separate builders taking down lots at the same time. Where we also use that with builders that would normally want to take them down, let's say 50 lots a year, to your example, which would take a builder 6 years to get into this project. That simply doesn't work for us. So instead, we tell them, look, we've got to get, at least 1 or 2 other builders in there, because we need to be in and out in less than 3 years. And then all of a sudden they change their tune and they're taking down lots, at 100 per year to meet our timeline and schedule.
Which is exactly what's happened with this project.
Exactly. Yes.
Well, to really hone in on the macroeconomic level of things that we really look at, and Nick, you can clearly speak on this or add to what I'm about to say, is we really pay attention to absorption. I don't know how many people in the room have heard the term or understand what it means, but absorption is something that any site work developer or, national home builder really pays attention to, is how fast these things can be absorbed, because they don't want to be caught holding paper either. So Nick, what are the things that we do to really pay attention to absorption in a market?
Yeah, it's a few things. It's understanding the home trends, right? Kind of what's happening in the market on both. And look, absorption is also a function of supply too. So
Correct.
it kind of goes both ways. Like we want to see a market with positive population growth, positive net migration. So we know sort of the input for people demanding homes and to buy homes that the builders will provide to them is there. And then we also want to make sure that there's not too much supply to support that demand, right? And so there's data that we can data resources we have access to understand that at a macro level, but then it's also getting into the market, talking to the builders. I mean, they have incredible data around what's happening where at what projects, and within an MSA, they may have 4 projects going. All those projects have different demand and supply drivers, and we're able to get sort of a look into that from them through our relationships and conversations with them. So, the builders and us are always negotiating on delivery schedule, but they're ultimately not going to commit to something that they don't believe in, because they want to sell a product, right? And so there's a give and take there, and it's like everything else we do. It is data driven, and it's here with the builders is actually there's a lot of relationship data too that we're able to uncover.
Absolutely. Get into the weeds a little bit more here, and this is the investment summary on this particular property. You can see in the location here, we're neighboring Highway 60, which is a major highway, and then 902, which is also a great state highway. So it's got good road frontage. It's a good layout. It's a very balanced site. The land purchase on this one, $7.8 million. Our equity is 1.3. Total project cost is about $25 million. And again, our project timeline is 24 to 30 months on this one, and it's a 30% average annualized return with about a 1.6 equity multiple.
Yeah, and Eddie, I just want to pause there just because I want folks to understand in the risk mitigation profile, how many opportunities can you have where you're not over leveraged in debt at all, and you've got a $25 million project and you only need to bring $1.3 million to the table. That's the value of getting those contracts with the builders and having the builders pay a deposit that gets used in our cap stack to diminish the risk profile and the equity pressures that are put on the project from our perspective. So it's our kind of global risk mitigation strategy there. I just want to point that out.
Absolutely. Glad you did. This is the location and the demographics. This is a Fayette County, Lexington MSA. A strong population growth. It's plus 7.9 from 2010 to 2022. It exceeds the U.S. growth of 6%. The total population is currently at 320,000, and the household income is plus 7.46. So really good, strong metrics here. So Shane, go ahead through all the numbers here and kind of explain out the different ways that we're not over leveraged.
Sure thing. Yeah, so you can see the sources and uses there in terms of the land purchase, construction costs, contingency, soft costs, finance costs, et cetera. That's what aggregates rather to that $25.3 million number. And then the sources, you got your senior debt, project equity, which is mostly the builder deposit. And then again, a little bit of our fund equity of the 1.3. Now, on the construction senior debt, you might say, well, geez, Shane, you said you weren't over leveraged. You're at 77% leverage. That's pretty high, isn't it? Well, it would be if all of that money was utilized at one point in time. The important thing to note here is that it's not only a loan to value ratio of 64%, but as that loan is utilized, it actually never crests about a 50% LTC in the project. And that's because, again, we're building expense and then we're getting income to pay that down. And then we're building expense and having income to pay that down. So even though we have to call a total loan amount of 19.4 million, we're actually never using more than about, $9.5 to $10 million of that construction loan senior debt. Nick, am I explaining that well?
Yep, 100%. And really, we only hit that max exposure point kind of just before the first tranche of lots starts to get sold. And then the risk begins to diminish, on a fairly consistent basis from there over the next 12 months until the thing's basically cleared out. So there's, 9 to 12 months of debt load build, you start to sell lots, and then you've got 9 or 12 months of pay down, and then you're free and clear. So
Yeah. So it's a really, really interesting business model where you have to call that much capital and you have to put it in the stack and say that you need a $19.4 million loan, but you're never actually functionally using more than half of it. And of course, we're only paying points we're paying points on the whole amount because we have to have it there, but we're only paying interest and fees on the capital that's actually being used out of the loan facility.
right.
Absolutely. One thing I want to point out is contingencies. Oftentimes we see a lot of people over leverage because they do not put contingencies in place. That is absolutely a must in any construction.
Yes.
So this is another project here, very exciting project. This one actually is a vertical. This is horizontal to a vertical phase. It's a build to rent community comprised of 188 townhomes, 70 single family homes. Again, this acquisition was an off market. It was sourced by us. We found it, put it all together. The vertical integration, this project will be developed as a ground up, horizontal to a vertical phase with the same sponsorship group. This again is an underserved market. We really got a lot of data on the Crestview market and it's continuing to grow. It's underserved. It's a great market. Reduce horizontal construction risk. Hampshire has a finalized horizontal construction contract and highly reputable site contractor. And then on the vertical, we're using a top 25 national home builder, and this is a fee build. So I want Shane to go in on a little bit of how we look at that with our contract language on the fee build side of the business instead of the forward contract.
Yeah, the fee build is pretty simple, right? We're paying them to just build houses, and we're really just paying them for the foundation to finish aspect, and so that's the sort of fee build relationship, and so we're leveraging the power, scale, and buying power that large firms have to keep our cost per square foot on the vertical component low, and really just paying them a fee to build that for us when the product's completed. So it's a really, again, a great kind of balance of risk mitigation rather than us having to go out and manage the entire process and manage 40 different subs. And I can tell you, because I did that for a long time, that's a lot of work, especially on a big community like this. And so working with a home builder that we can essentially offload all of that responsibility of going vertical and building the foundation to finish on, we know we're getting the best pricing, great quality, and they have the best resources in that given submarket to deliver the product for us much better than we could ever do on our own. And so we kind of get the best of both worlds in terms of pricing and counterparty capacity and ability to deliver a great product at a great price.
Absolutely. And I really want to bring this into color. The 25 national home builder, here's the buying power they have. If we were to go to Home Depot and submit a set of plans, and we're going to go buy our own trusses, lumber, siding, everything else, and go manage these 40 subs, probably cost us $140, $150, maybe even $170 a square foot to build these homes. We're close to $100 a square foot. And that really speaks to, we could never get that low trying to manage this yourself. So you're just a lot better off to do a national home builder that has the relationships with the supply companies to get that cost per square foot as low as it is.
Yeah. And Eddie, they're delivering close to $100 a square foot, including their profit and overhead. We can't even build it for that.
Right. 100%.
Let alone our profit and overhead. Right.
Absolutely. Yeah. So the last thing here is it's limited new supply. So again, Nick and Mo, we really dug deep on this and we really wanted to understand what is being delivered at what time when our project is finished And we really are delivering these units and the new construction wave that Crestview has experienced. So we're coming in at a time where we'll be the only one delivering at this time in the Crestview market. So it really will help our lease up. And again, we are a data-driven company. So Nick and Michael Payne went out and they actually interviewed 3 separate property management companies and really honed in on what do they know that they're being asked right now for a lease up? How long does it take to lease it up? They asked all these questions. They made sure that we had good data that tied this in. The investment profile, capitalization overview. This is a $57 million project. You can see our construction senior loan, our common equity, and then the LP equity investment and the HC fund investment. And then we have our project unlevered and levered, or a levered IRR, and this one is a 2x multiple.
Yeah, and Eddie, just to clarify a few things here, we are partnering with a large institutional developer on this project. That is the LP investment capital, and the 1.5, 1.6 million that Hampshire will bring to the table through the fund would be our 10% of the total equity required.
Mo, if you want to go through this real quick, I know you've done a ton of research here and housing vouchers and stuff like that. So take it away.
Yeah, and I'll step back a little bit. I mean, thanks again, Eddie. I mean, in addition to total return and velocity of capital, we think about land development investment opportunities through the lens of really delivering locally based resi solutions, and we look to also seek for strong municipal partners, right? In that sense, and so that's something we certainly appreciate. And again, Shane alluded to risk mitigation. That's kind of one of the many ways we really kind of drill down on a local level. But going to Crestview, we think about this market in terms of housing shortage. We've seen downward pressure for attainable housing kind of move away from those coastal areas towards really inland, right? And so we think and we see Crestview as a market ripe for attainable housing. And I'll kind of go through some of the bullet points. Again, it says Crestview is benefiting from the growth of Fort Walton Beach and Destin, kind of big picture. Strategically located 22 miles from Elgin Air Force Base. Again, the Shoals River is a gigasite project that's really going to be a huge employment driver for that market. And so again, these are important key indicators that we look at when we kind of enter a market and say, okay, this is going to be the right fit in serving this community.
Thank you. A little bit more on the location here. We can see that we have, major brands here that's close to us. We got McDonald's, Burger King. There's certainly a lot more that's close to it. Over here on the upper hand side of that picture, you can see there's a small little development there. So there's really nothing that's condensed is what we're bringing to the market and nothing that's new. So it's definitely exciting to bring this project into Crestview, and it's 34 acres. The median household income is $57,000. And the Crestview, and then the regular median household income on the site is about $64,000. So we're not asking too much here. Our rents are right in line. Project sources and uses here. We got a $42 million senior loan. And then you have your common equity, your LP, and your sponsorship. And then acquisition costs, hard costs, soft costs, financial costs, everything here in sources and uses. If anybody wants the underwriting for this, please put it in the chat. We'll get it emailed to you. And we want you to understand all these numbers. We just put these in here as a guide.
Yeah, and just to speak on a couple things here, Eddie. So we're looking at about a 25,000 per unit cost basis here for this project. The market for this stuff, if we just did this in a traditional manner without the creative things we're doing on the construction side, and the fact that we have a very attractive land basis for the cost of the land, is more like 240 to 250,000 a unit. So that's part of what's helping drive the high returns here for this project, is the fact that the way we've structured and negotiated this deal, we're able to get a very compelling kind of going in cost basis.
Absolutely. Go ahead, Nick.
So it's a 5-year pro forma projection. A lot to digest here, but essentially years 1 and 2 are the lease up years, and really year 3 is that stabilized operational year, which is where basically the business plan is to develop the deal, lease it up, stabilize it, and sell it. So that year 3 NOI and income is really what we're looking at driving toward here. And that return on cost calculation at the bottom there, starting at an untrended 7.3 and stabilizing in year 3 at 7.7. Really what that reflects is essentially the same thing as a cap rate would in a traditional deal. And what this is saying by having a 7.7 return on cost with the market cap rates today, 5.75 to 6, is that we've created a substantial spread in value creation here. And so that's why we're excited about this deal. And the way we're able to get that high return on cost is, again, back to the cost mitigations on the basis side from the front end on the development.
Go ahead, Nick.
Yeah, on the exit analysis, again, kind of that 3-year hold, lease up, sell at stabilization plan here. We've put what we feel is a conservative exit cap of 6%, which again is kind of market today, but we think the market's going to be a lot more attractive in 3 years. And we also toggle that to make sure that our per unit number there at $291,000 a unit at the sale doesn't go too crazy and haywire with a low exit cap rate. The median home value in the market is about $350,000. We feel like planning to sell this BTR build to rent project in 3 years at 14-15% below where the market is today is a pretty safe assumption.
Absolutely.
Yeah. Also, just given the fact that that's median home price, that's not average home price of new construction homes, which is what these would be.
Correct. Absolutely. So the fund investment return and timeline here, the fund level returns for this one is 25% average annualized return, and that's a preferred return. The investment hold period is 3 years, and that's the sale and the once it's stabilized in 2028. The fund contribution here, and then you can see the total fund distribution, the equity multiple, and the IRR. And then you can have our project timeline and key milestone dates here on the bottom. So closing here in December, starting construction in January, and the vertical construction starting in May of 2025, leasing starting in October, and then construction completion at the September 26th timeframe.
Yeah, we're going to be delivering this project in phases. And so there'll be a period of time where we're delivering finished product, beginning leasing while finishing construction. So we're not building the whole thing out and waiting for 2 years before we start to generate revenue and operation all income. We'll be doing that over a series of Eddie, is it about 7 or 8 different phases?
Correct.
Yep.
Absolutely. So time for Q&A. I'm hoping that Brendan didn't answer all the questions in the chat. Hopefully we've got some left. If not, let's go ahead. I want to make sure that everybody can talk. All right. Anybody have any questions? Michael, what's your thoughts on this project?
I guess referring specifically to the Crestview project, what I love about what we've done is in the investigations that Nick and I have done with, from a property management standpoint, we've learned what are all the different amenities that we need to have to make sure that we're beyond competitive, so that the rents that we're setting based upon all the pricing structures that you've just gone through are more than competitive, give us a competitive advantage for how we get all of the leases in that area from a new startup standpoint. I'm excited about the opportunity there because I do feel like it's a growing area. I feel like that with Elgin Air Force Base just south of us, fueling some of that, being the largest Air Force base in the country and does most of the training of all of our Air Force personnel, that it sets us up for a huge success. The other thing I like about the area is well diversified. It's not just Air Force personnel. There are different contractors, there are different bases everywhere. From that standpoint, from a Crestview standpoint, it's an opportunity that I think is a well put together package that can have some great returns.
Absolutely. Does anybody have any questions? All right. again, if you have any more additional things that come up, please reach out to Brendan. He will get those answered. He's got his email there in the chat. If you need anything at all, you need the underwriting, you need a little push to understand the project. We're happy to go over the underwriting with you, schedule a meeting. Please do so. We hope everybody have a wonderful day. Thank you very much.
Thank you.
Thanks, everybody.